There is a specific letter the IRS sends when your tax return reports less income than their records show. It is called a CP 2000 notice, and it is not a bill, not yet. It is a question. It says, "You reported this amount. We have information suggesting you received this other amount. Please explain the difference." People who receive it describe the experience as uniquely unpleasant because it arrives months or sometimes years after the tax year in question, covers income you may have genuinely forgotten about, and comes with a proposed balance due that includes interest calculated from the original date you were supposed to have paid. The reason this matters right now, in 2026 specifically, is that a law passed on July 4th of last year changed when platforms like Venmo, Etsy, PayPal, and eBay are required to send you a tax form, and most side hustlers heard that news and quietly concluded they were no longer on the IRS's radar for small amounts of income. That conclusion is the gap this video is about, because "I'm not getting a form" and "I'm not in the system" are two completely different things, and only one of them changed. By the end of this video, you will know exactly what the law changed, what it didn't, which platforms treat you differently than others, and what you are supposed to do with income that arrives with no paperwork attached. If you leave now, the gap stays open. Before we go any further, everything covered here comes directly from IRS publications, the text of the One Big Beautiful Bill Act as signed on July 4th, 2025, and Public Tax Code. This is financial education, not personal advice for your specific situation. So once you understand what the rules say, take that understanding to a CPA who works with self-employed people and let them apply it to your numbers. That step is not optional if your side income is real money. We are going to cover 5 things in order. First, what the One Big Beautiful Bill actually changed and why the timeline matters. Second, the 1,099K rule that everyone is talking about, and why the relief it provides is more limited than most people realize. Third, the change nobody is talking about, which is the 1,099 NEC threshold jumping from $600 to $2,000 and directly affecting every freelancer paid by a client. Fourth, a platform-by-platform breakdown of who will and will not receive a form in 2026, because the answer is genuinely different depending on where you earn. And fifth, what you are actually required to do regardless of which category you fall into. If you find this useful, subscribing takes 2 seconds, and it means more content like this finds you automatically. But that can wait, because the information comes first. For 4 years, the IRS was slowly walking toward a rule that would have required every payment app and marketplace, Venmo, PayPal, Etsy, eBay, Cash App, all of them, to send a tax form to anyone who received $600 or more in a year. That rule was written into the American Rescue Plan Act back in 2021, and the IRS delayed it repeatedly, which created years of confusion where people genuinely did not know what threshold applied to them or when. That confusion ended on July 4th, 2025, when the One Big Beautiful Bill Act was signed into law. Section 70432 of that legislation did something that had been debated for years. It repealed the $600 threshold entirely and returned the reporting requirement to the standard that existed before 2022, which is $20,000 in gross payments and more than 200 transactions in a single calendar year on a single platform. The IRS issued formal guidance confirming this on October 23, 2025. That is genuinely good news for a large group of people. If you sold some items on eBay, got paid through Venmo for a few odd jobs, or moved some merchandise on Poshmark and stayed under $20,000 on any one of those platforms, no paperwork is coming your way from that platform, and the form that a lot of people were dreading is not showing up in your inbox in January. Understanding what actually changed and what did not is where it gets important. A Form 1099K is an informational document that tells both you and the IRS what a platform processed on your behalf, and the threshold change tells us when the platform has to send that document. It does not say anything about whether the money you received is taxable. Under the Internal Revenue Code, income is income, and if you received payment for goods or services, it goes on your tax return regardless of whether any form ever arrives, because the form is the paperwork and the obligation exists independently of the paperwork. Think about it this way. Imagine you got paid in cash for 5 dog-sitting jobs with no app involved, no platform, no electronic payment, and nobody sending you a form because nobody ever was. If you earned that money for a service you provided, it belongs on your tax return, and the $600 to $20,000 threshold change is about digital platforms being required to send a document, not about whether the income those platforms processed is taxable. The dog-sitting cash analogy has applied to every dollar ever earned through those same platforms, and it still does. A lot of people heard $600 rule is dead, $20,000 threshold is back, and put a mental checkmark next to their side income, and they are now operating on an assumption the law does not support. The IRS knows that assumption is widespread. On-screen text, Form 1099K threshold, $20,000 plus 200 transactions. Your tax obligation, every dollar you earned. What that means practically is that the people most at risk right now are not the ones who ignored the $600 rule when it was in effect. The people most at risk are the ones who were nervously paying attention to the $600 rule, heard it went away, and stopped paying attention entirely, because the form threshold went up while the audit risk for underreported self-employment income did not go down. We will look at specific numbers and specific platforms shortly, but first there is a second change buried in the same legislation that affects freelancers and independent contractors directly, and that almost nobody is covering. There are two different tax forms that carry most of the freight for people who earn outside of a traditional job. The 1099K, which we just covered, is the form that payment apps and marketplaces are required to issue when they process payments on your behalf. The 1099 NEC is a different form entirely, where NEC stands for non-employee compensation, and it is the form a business or individual client is required to send you when they paid you directly for work outside of a payment platform and the total reached the reporting threshold. If you freelanced as a writer, designer, photographer, or consultant and a client paid you $800 by bank transfer for a project, under the old rules, that client was required to send you a 1099 NEC and a copy to the IRS by January 31st. Section 70433 of the One Big Beautiful Bill Act changed that threshold from $600 to $2,000, starting with payments made in the 2026 tax year, and clients paying you less than $2,000 in a year are no longer required to send a form. That threshold is also adjusted for inflation annually beginning in 2027, so it will drift upward over time. On the surface, this sounds like a simplification, and for small one-off engagements it is. But for freelancers and contractors working below the $2,000 per client threshold, this change creates a real risk, because clients who used to send a form as a matter of routine now do not have to, and when no form arrives, some freelancers will unconsciously treat that income as off the books. It is not off the books. The same logic that applies to the 1099K applies here. The form is an informational document that helps the IRS match what you reported against what your clients paid, but your obligation to report the income is written into the tax code, not triggered by the existence of a form. A client not sending you a 1099 NEC because they paid you $1,800 does not make that $1,800 invisible to your tax return. It makes you the only person responsible for remembering it. For someone doing a handful of small projects, for $100 here, $800 there, $1,100 there, the threshold change means no forms from any of those clients and no external cross-check from the IRS to catch a mistake if any of those amounts gets left off a return. The IRS is aware of this dynamic, and the way they typically catch underreported self-employment income is not through form matching alone, but through comparing the lifestyle and spending patterns of taxpayers whose reported income looks inconsistent with what the IRS knows about their transactions. This is also the part that affects how you work with a CPA. A good tax professional working with self-employed people will ask you to pull your own records rather than just wait for forms. Every project, every invoice, every transfer, every Venmo payment for work, because in 2026 more income than ever before will arrive with no form attached, and the only accurate account of what you earned is the one you kept yourself. We have covered the two changes in the law. Now let us get specific about where you actually earn money, because the answer to will I get a form is genuinely different depending on the platform. Let us go through the platforms where people actually earn side income, because the 1099K rule does not apply uniformly, and the differences matter. Venmo and PayPal operate under the same parent company, but the 1099K threshold applies per platform, not across both combined. If you received $15,000 through PayPal and $7,000 through Venmo for goods or services across the year, neither platform hits the $20,000 threshold independently, so neither is required to send a form. But the $22,000 total you earned is still taxable income, and the IRS has access to transaction-level data through other means including bank reporting requirements. One important clarification. The $1,099K threshold under the new law applies to payments for goods and services, not personal transfers like splitting a dinner bill or reimbursing a friend for groceries, which are not taxable income and are not what the reporting requirement is designed to capture. PayPal and Venmo both allow you to designate whether a payment is personal or business, and if you are running any kind of income-generating activity through those apps, using the personal payment designation to avoid a form is not a legitimate strategy. It is an inaccuracy. Etsy sellers below $20,000 in gross sales and fewer than 200 transactions will not receive a $1,099K from Etsy for 2026. Anyone operating an Etsy shop is running a business in the eyes of the IRS, though, and profit from that business belongs on a Schedule C, which is the form self-employed people use to report business income and claim business deductions. Schedule C is where you tell the IRS what you made and what it cost you to make it, so that only your actual profit is subject to tax, and not receiving a $1,099K does not mean you skip it. It just means no form is arriving to prompt you. eBay works the same way under the new threshold, with sellers under $20,000 and 200 transactions not receiving a $1,099K. There is one important nuance. If you are reselling personal items at a loss, meaning you paid $200 for something 2 years ago and sold it for $100, that is generally not taxable income. But if you are buying to resell at a profit or regularly selling new merchandise, you are operating a business and the profits are taxable whether eBay sends a form or not. Poshmark and Facebook Marketplace work similarly under the federal threshold, with casual sellers under $20,000 on either platform not receiving a $1,099K. That will feel like a major change from what was coming under the $600 rule, and for a lot of part-time resellers it genuinely is simpler. But people who are doing this regularly, buying inventory and reselling for profit, are running a business, and the simplification of paperwork does not change the underlying tax obligation. Rideshare and delivery platforms work differently. Uber, Lyft, and DoorDash drivers operate in a category where the platform's practices often exceed what the law requires, because of the way earnings are structured with guaranteed base rates, bonuses, and tips, and because of the new no tax on tips provision in the One Big Beautiful Bill Act, which allows qualifying workers to deduct up to $25,000 in tip income from their federal taxable income. That deduction only applies if tips appear on a reported form, so it is strongly in the interest of these platforms to send a $1,099K to every driver regardless of the $20,000 federal threshold, meaning many full-time drivers on Uber, Lyft, and DoorDash will receive a $1,099K even if their annual earnings fall below that threshold. Not because the law requires it, but because the platform is issuing voluntarily. Several states also have lower thresholds than the federal rule. Maryland and Virginia require a $1,099K at $600, and Illinois and Vermont have separate lower limits. So if you earn through any gig platform and you live in one of those states, your state may require a form even when the federal threshold is not met. Verify the rules for your specific state at your state's Department of Revenue website before assuming the federal threshold is the only one that applies to you. Fiverr pays freelancers through its internal payment system and issues $1,099K forms based on the federal $20,000 threshold, but freelancers earning on Fiverr, who are also paid directly by clients outside the platform, through invoice, bank transfer, or apps like Zelle, are in $1,099 NEC territory. Under the new $2,000 threshold, clients who paid them less than $2,000 are not required to send a form, which means the freelancer's own records are the only reliable account of what they earned. Airbnb hosts have a slightly different situation because the $1,099K reporting for rental income involves different rules depending on whether the host is treating their Airbnb as a business or as a rental property, and that distinction matters for how the income is reported and what deductions apply. It is genuinely one of the cases where a CPA conversation is worth more than a general video explanation. Though what does not change is that the income is taxable either way. The common thread across every single one of these platforms is that the form is informational, the obligation is independent, and in 2026, across most of these platforms, fewer forms are coming than before, which means more of the responsibility for accurate reporting sits with the person who did the earning. Most people assume the IRS catches tax mistakes by matching the forms you receive against the return you filed. If you got a $1,099K for $3,400 and only reported $1,200, the IRS sees the mismatch and sends a letter. That matching process is real and it happens, but it is only one of the tools the IRS uses, and it is not the one that creates the most risk for people in the $30,000 to $150,000 self-employment income range. The more significant tool is what analysts call an economic reality check, though the IRS does not use that term publicly. The agency has access to a remarkable amount of financial data, including information shared by financial institutions under bank reporting requirements, property records, business license filings, and state tax return data. And when someone's reported income looks inconsistent with their visible financial footprint, the mortgage they took out, the car they financed, the business they registered, that inconsistency creates a flag. The reason the lower form threshold actually increases this kind of exposure for some people is counterintuitive. Under the $600 rule, a massive volume of 1,099K forms would have arrived for small amounts of side income, and most of those people would have reported it correctly just because the form existed. Now that those forms are not being generated, the IRS is aware that a large population of earners who used to have a form matching check no longer has one, and they are also aware that this income is now more likely to be underreported. This does not mean everyone who earns below the $20,000 threshold is going to get audited, because statistically most people do not. What it means is that accurately reporting income you received without a form is not heroism or overcompliance. It is what the law has always required, and operating as though the absence of a form creates some kind of gray zone is an assumption that does not hold up. One more thing worth understanding about how your return gets read. When you file a Schedule C, which is the form where self-employed people report business income and expenses, you are essentially showing the IRS a profit and loss statement for your business. If you gross $25,000 in freelance income and report $3,000 in expenses, your net profit is $22,000, and that is the number that gets taxed. And if those expenses are legitimate and documented, that process works exactly as it is supposed to. But a Schedule C that shows unusually high deductions relative to income, or income that seems low relative to what the IRS knows about your platform activity, is one of the factors that triggers a closer look. The way to protect yourself is not to underreport income, but to report accurately and document your expenses completely. The question is not whether you need to act on any of this. The question is in what order to do the things that matter. The first thing to do is build a real income record for 2026 right now, before the year gets away from you. Go through every platform where you earn money and pull the transaction history for every month you have already worked this year, export what you can screenshot, what you cannot export, and get that data into a simple spreadsheet where every line item shows the date, the platform, the amount received, and whether it was for goods or services. It does not need to be sophisticated. It needs to be complete because platform transaction histories are not always fully accessible for the prior year. Some apps archive or limit historical access, and your memory of which payments were work-related becomes less reliable the further you get from when the money arrived. The second thing to do is separate personal platform payments from business ones. If you use Venmo for both splitting dinner bills with friends and receiving payment for work, those two categories need to be visibly different in your records. The IRS does not require you to have a separate bank account or a separate app for business income, though both of those are genuinely useful, but it does require that you know which transactions are income and which are not, and that you can demonstrate that distinction if asked. Leaving everything in one undifferentiated pile creates a situation where, in a CPA conversation or an audit, someone else has to make judgment calls about your transactions, and those judgment calls may not go the way you would have made them yourself. Third, track your expenses the same way you track your income. A business expense, in the IRS's view, is an ordinary and necessary cost of operating your business, meaning something that people in your industry typically spend money on, and that was genuinely for the business and not personal. If you buy supplies for your Etsy products, those are deductible. If you pay platform fees to sell on eBay, those are deductible. If you use a portion of your home exclusively and regularly for work, a portion of your rent or mortgage interest and utilities may be deductible through the home office deduction, which reduces the total business income you are taxed on not as a bonus at the end, but as a subtraction from the starting number. A $500 home office deduction does not give you $500 back. It means you pay tax on $500 less of income, so the actual benefit depends on your tax rate, but that is still real money, and understanding the mechanics prevents disappointment. Fourth, if your net self-employment income for the year, meaning your total business earnings minus your business expenses, is likely to reach $400 or more, you are generally required to file a tax return and pay self-employment tax on that income. Self-employment tax is the contribution to Social Security and Medicare that when you had a regular employer, you and your employer each paid half of, and when you work for yourself, you pay both halves. For 2026, the combined rate is 15.3% on net self-employment income up to approximately $176,100. Verify the current figure at irs.gov because this adjusts annually. That means on $10,000 in net self-employment earnings, you owe roughly $1,530 in self-employment tax alone, before any federal or state income tax. And if nobody is withholding taxes from your side income throughout the year, the IRS generally expects you to make quarterly estimated tax payments due in April, June, September, and January to avoid an underpayment penalty in April. A CPA can calculate the right amount for your situation, and a rough starting point is setting aside 25 to 30% of every payment you receive until you know your actual rate. Fifth, for anyone whose side income is becoming meaningful, let us say you earned more than $15,000 net last year from self-employment or you expect to this year. A one-time conversation with a CPA who works specifically with self-employed people is not an optional extra. It is the single highest return investment available to you. A competent CPA will identify deductions you did not know existed, calculate your estimated payments correctly, and explain whether your income level makes an LLC or other business structure worth considering. That conversation typically costs between $200 and $600, and the average amount it saves people who have it for the first time is substantially more than that. The cost of not having it is usually invisible until April, when it arrives as a balance due. If you are finding this useful and you want more content that covers how the tax code actually works for people earning outside of a traditional job, subscribing ensures it keeps showing up for you. The next video covers the specific deductions that most freelancers and side hustlers miss, real ones with numbers attached. The thing most people get wrong about 1099 forms is thinking of them as the start of a tax obligation, as if you get the form and only then do you owe the tax. That is backwards. The obligation exists the moment you receive payment for goods or services, and the form, when it arrives, is simply the government's way of confirming it knows what you earned. When the form does not arrive, nothing about the underlying obligation changes. It just means you and the IRS are both operating from their respective records, and the only question is whether your record is complete enough to support what you filed. The 2026 changes made it so that a larger number of people than before will file their returns without a single 1099 form arriving in January. Some of those people will interpret that as good news and stop there. The ones who understand what the changes actually said will interpret it as a reason to keep their own records more carefully than ever, because they are now the only cross-check in the system. A question worth leaving in the comments. Which platform is your largest source of side income this year? And do you actually know whether it will send you a form? Not do you think it will. Do you know what threshold your platform uses and whether you are on track to hit it? That answer is worth finding before January. Subscribe if you want the full picture on deductions, estimated taxes, and what the rest of the One Big Beautiful Bill means for self-employed people in 2026. The next video is already there.